LinkedIn is pretty great at a lot of things, like helping you tap into the latest trends and insights in your field. We cannot stop your coworker from tapping her pencil. LinkedIn can help you find new jobs that align with your career goals. We cannot help you find the source of that weird smell in the office fridge. Ew. And while we can't stop your coworkers from bringing their hobbies into the office, LinkedIn can help you bring your career to the next level. LinkedIn is the network that works for you.
This Friday, Crime 101 hits theaters.
What is it that you do?
I take high-value items and make them disappear.
So you're a thief.
One crime connects them all.
I'm getting close. I know it.
But only one will walk away.
I underestimated you.
Chris Hemsworth, Mark Ruffalo, Barry Keoghan, and Halle Berry.
We're good at this.
Yeah.
Crime 101, directed by Bart Layton. Rated R, under 17 on admitted without parent. Special sneak previews Monday, everywhere Friday.
The Dental Download podcast is your source for insight from conversations with fellow dentists, specialists, and leaders in the industry. With new episodes every Monday morning, I'm your host, Dr. Haley. Let's get into this week's episode. Hello, everyone. Happy Monday. Welcome back to another episode. We are here for another financial-based episode all about the physician home loan. But this is the Dental Download. What are you talking about? It's just a title for a loan that physicians, but also dentists can qualify for. And we're going to talk about how we utilize this to fund the loan to build our custom home. So I'll talk about it as more of a broad category, whether you're buying existing or building, but we'll also get into the nitty-gritty of building and how it makes it different, how the loans work. What have we had to pay throughout the building process? What are hidden expenses? How does it work? Who can qualify? And I'm going to add in our personal experiences from the perspective of doing a physician loan of a construction to permanent mortgage, which is a single close loan. And that is what allowed us to build our custom home by putting 0% down was our decision. So 100% financing. Spoiler alert, even though we didn't put any money down towards closing on the loan, we're still paying a lot out of pocket because we opted to do construction instead of buying existing, and there are always extra costs. So I'll be very transparent with you about what it looks like to build a custom home, what it could look like to build a custom home if you decide to go this direction. So what is the physician loan? A physician home loan is a specialized mortgage designed for medical professionals, including dentists, that offers flexible underwriting compared to conventional loans. They are created to account for your high student loan debt and delayed earning timelines common in healthcare careers. They often feature things such as 0% to as little as 5% down. They pretty much never, from my understanding, have private mortgage insurance, PMI, which just adds on to your monthly mortgage. So that's savings. And they often don't consider your student debt as stringently when they're looking at your debt to income ratio. And sometimes the rates can be better and sometimes they're not. So we'll get into, later on, is this even worth doing? We'll talk about it. I have a bunch of questions that you all sent in. You asked questions on TikTok. So if you're coming from TikTok, hello. I had a video that got a decent amount of views over there. So if you're coming to listen to this full episode from TikTok and it's your first time, welcome to the podcast. We're almost 6 years strong coming up in April, which is so awesome. And all of you who are loyal listeners every week, I love you all so much. You're my favorites. But let's get right into your questions. Do you need to be an owner doctor to qualify if you're a dentist, or can associates do it? You all know I'm an associate, so obviously associates can do it. If you're a physician resident, technically you can qualify. It is a lot harder to do the construction loan than buying an existing. I don't want to keep harping on the same thing over and over, so I'm going to try to keep this in categories. But who is eligible for this? It is typically going to be dentists and physicians, veterinarians, and pharmacists. And I think some banks will do optometrists, but not as common. And some banks, pharmacists is a little wishy-washy. Unfortunately, less common, or really not common at all, would be a chiropractor, PT, CRNAs, PAs, NPs. But you never know. Definitely look into it if you're in healthcare or if your partner that you're with is. And can you qualify right out of school? Absolutely. For buying existing. As for building, from what I gathered, you need to have a year of proof of income in your profession. Does student loan debt affect eligibility? That's kind of the purpose of why this loan even needs to exist. Because if you have $400,000, $250,000 of student loan debt, and you're going to apply for a conventional mortgage, typically that is going to be hard to get a loan because you also probably don't have that many assets either. You probably don't own much. You probably haven't been investing during school. You probably barely have any money. Plus, you just have a lot of debt. So traditionally, you're not a good candidate to get a mortgage loan. But that's why this exists, because they know that you have such high earning potential that they kind of don't look at the student loan debt as heavily and can approve you for an amount mostly just based on your anticipated income rather than looking at your debt to income ratio, which is what banks traditionally do. And is this loan only for first-time home buyers? No. But again, all of this is going to be bank specific, but typically you can do this at any point in your journey. You just have to see if it makes sense, because there are reasons why a traditional mortgage route could be better than this, but this is really helpful if you're in a scenario like we'll talk about. People also really wanted to know, like, will I qualify in terms of credit score? You definitely need credit. So if you've never had a credit card and you don't have credit, start working on it. A credit card score or credit score that's typically required would be at least around a 700, I would say. The internet says between 680 to 720 is the minimum. Of course, the higher you have, the better. So if you have a 760 score, a 770 score, that's going to help you likely get approved for a higher loan amount, potentially not needing any down payment or a much lower down payment, and also probably buy you down a few fractions of percent of your loan interest rate. People wanted to know a little bit more about the credit scores, so I'll just kind of zoom through it because I'm obviously not a mortgage lender. I am a dentist. But is the score required higher than conventional loans? No, I would say that's pretty standard. What happens if your spouse has a lower credit score? You would not want them to apply to the loan. You would want to apply to it to be all in your name. If they have like a bad credit score, like a disqualifying credit score, then you probably just don't want them involved in this process and just go through it all independently as yourself. If not, if you are applying with a spouse, like I applied with my fiance, we weren't married yet at that point, but now we are. They factored in both of our incomes, they factored in both of our credit scores, and some banks are going to use an average of your scores, or some of them will just look at the person with the lower score. So you want to make sure that you're both good candidates to get a good loan. What other factors are they looking at? They're going to be looking at your employment contract or offer letter, but typically it needs to be a signed contract from what I was experiencing of reaching out to banks. They're going to look at your income trajectory, so your chosen field within your discipline. They're going to look at your credit history. They're going to look at your cash reserves, all your different assets, investments. You should typically not need a cosigner for this. And they're also going to look at your student debt just to know, but it's a more favorable calculation from my understanding. Obviously, I'm not in the inside knowing exactly how they work us up, but those are all things that we had to submit. So how do the employment contracts factor in? How do they look at your income? If you're already working, then obviously you have pay stubs. Maybe you already have a W-2 if you've worked a full year. So that's what they're going to look at. But if you're coming right out of school, they typically need the signed employment contract, not just an offer, because the offer doesn't really mean anything because it's not a guarantee of that practice paying you. And the tricky thing with dentists, right? We know a lot of times you have maybe a 3-month, maybe a 6-month guaranteed rate, but you either hope to earn more or you have unpredictable income after that time. So that's what makes it a little tricky for these offices, these banks to approve you and to kind of know what amount they can approve you for. They're only going to go off of what they have evidence for. So they're not going to assume because you said, well, the other doctor makes $5,000 more per month than my guarantee, so I'll probably be doing that in 6 months. They don't care. They're going to go off of your daily rate. So if you want to get approved for higher or you apply and you're not approved for as much as you'd like, I would reapply once you have more higher earning pay stubs to show proof of that. Again, for me building, I needed to have worked pretty much a year for them to see that I was actually making the money I was supposed to make. But they did still see my signed contract, even though I was past my daily rate and past the guaranteed time. So they were looking at pay stubs for me. So what's so appealing about 100% financing? Why would anyone want to put 0% down? And how is this even possible? Why are banks letting you do this? Because physicians and dentists are really good clients. They very rarely default on their loans, and they are reliable, responsible professionals. Why would someone want to do 0% down? In my case, we didn't want to put anything down because we knew we'd be spending a lot or could be liable to spend a lot during building a custom home, which I will talk about in a couple moments here, how much we're spending out of pocket and how all of that works. But we didn't want to take all of the money that my husband had saved up over his 5 years of working while I was still in dental school and put it all toward the down payment on a house and have nothing left, because we aren't prepared for the expenses of home ownership, surprises that could come up. We wouldn't have any money if the build went over budget, which they always pretty much do. So we didn't want to wipe out all our savings and be stressed. So we chose to finance more, and in our case, finance 100% of what we anticipated our house to cost. If you're buying existing, again, you know exactly how much the house costs. There's not really so much surprises that could go throughout it other than once you're in the house. If it's an older house, things can break down. Maintenance you weren't expecting. Maybe you need a new roof or a new heater. So that's all stuff, again, you want to keep money on hand for those things if you're going to decide to become a homeowner. And if you don't have a lot of savings, that's why this is really appealing, because most people coming out of professional school don't really have any savings and all you have is debt. And then now you're making this really high income. So I would say that it's advantageous in our situation a lot of the times if you're freshly out of school to opt for something like this, and then you can always refinance later, or if you really hate debt, you can still pay it down aggressively later if you want to. If you don't want to have 30 years of a mortgage and you don't want to pay hundreds of thousands, maybe even $1 million of interest, you can still do that. But right now, it keeps more money in your pocket, which gives you more peace of mind and more flexibility. Are the interest rates worse than doing a conventional loan? In my opinion, I was finding they were pretty much the same rates that everyone else was getting, unless you were able to put 20 or 30% down, which again, we just weren't comfortable taking that much of our cash reserves towards a house in general at that point in time, which was over a year ago when we started this process of figuring out what we wanted to do. But I have friends in like other states. So obviously interest rates are different across states slightly, but it's mostly like a national average, I would say. And I have friends that put a lot more down and went conventional and were able to get a lower rate than we have. But then I have friends who did physician loans for existing houses and have a higher rate than us, even though we did a build. So it really is just bank to bank. It's shopping around, seeing what rates you can get. It's week to week, unfortunately. One week they can be 0.2% higher or lower, but in the long term, it's not worth losing sleep over 0.2, 0.3, 0.1%. If it's a whole percent point, I think that's worth considering, but that's where you need a really good financial advisor. So I didn't mention this, but before we started all this, we talked to our financial advisor, and our financial advisor is dental specific, and he looked at how much we make, how much we want to save, what we want to do in life, and gave us a number where he said, I would not go any higher than this hard stop. That is too much money. You're going to be stressed about your monthly expenses. And we picked a number much lower than that. And then you get into the process of shopping around and you get into the process of figuring out what you want. Because of course, we didn't just say, we're going to go build a custom home. Like, that's a little aggressive. We did look around at buying existing, but there is a lot of land where we live, and all the existing houses just had a lot that I would want to change and renovate. And we're not really handy people, and it would have just been annoying to do. It would have added expenses. It would have been difficult while you're living in the house. And for me, it also just felt wasteful because these were they were nothing wrong with them. They weren't dingy, old, moldy, gross homes. They were just not my style. So it felt kind of wasteful to go in and knock everything down and get rid of all this stuff that was still functioning just fine. So I preferred to build from scratch once we realized that it was an option for us, which we never thought would be possible till we learned about how all this works. So that's why I wanted to share it, so that you know kind of what is possible. What is kind of the main difference between these physician loans, typically what I see and what I was quoted, and a conventional loan is most of the time if you go to the bank and you're buying a house, you're going to take out a fixed 30-year mortgage. Some people do 15 if they really want to pay things off early and they want to have less overall interest that they paid. But for me, I'd rather spread it out. I don't typically really care about all the extra interest because I like having more money on hand, and that's just my philosophy of it all. But they don't really offer that from what I was seeing in my area and friends in other states. For the physician loan, they were either a 5-year or a 7-year ARM. It's an adjustable rate mortgage, which means that at the point of your 7th year, the bank is going to tell you for the remainder of your 30-year mortgage, you have a new interest rate of XYZ. And you just have to be okay with that. In my initial contract, I saw the highest it's allowed to go up per year, and I saw the highest it could ever be. It can't be more than a certain percent. So it's not outrageous, but it wasn't great either. And they could go down technically, but I don't ever imagine why that would happen. So I don't see that ever happening. But typically what then you're going to expect is that before you reach that 7-year period, you're going to pay to refinance this loan into a conventional 30-year and no longer be a physician loan most of the time. But then you would be taking back on the things that you had gotten rid of as a benefit, such as PMI a lot of the time. Then you have to take that back on. So it's a very intricate process and specific timeline that's going to all depend on the market and real estate and your personal finances of when the time works to do that. But that's the biggest thing I noticed, that they're pretty much all 5 or 7-year ARMs instead of 30-year fixed rate, which just means the rate that you sign today is locked in for all 30 years, unless, again, you pay to refinance. So generally, people are more comfortable with the idea of a fixed rate because there's less unknown. So that is a downside of the physician loan. But I had someone comment on my TikTok saying that they got a 30-year fixed physician loan. So maybe some places offer it, or maybe they didn't know what they were talking about. I don't know, but I don't personally know anyone that has ever been able to do that. We talked about this question, but I'll answer it again. Why would you want to put 0% down? It allows you to have more money, as I said, on hand. You can continue investing. If the stock market is higher returns than your interest rate, this is like basically words of a financial advisor, but in theory, it is better to get gains in the market that outweigh the interest you're accruing on debt if it's lower interest debt. I'm not talking 28, 30% credit card debt, but a 5 or 6% mortgage. If you can earn 10, 15, 20% in the stock market, technically people say that's better. I'm not an advisor. I'm just sharing what I have gathered. All right, fellow dentists, are you feeling overwhelmed by student loans or confused about your financial future? Our sponsor, Twin Leaf Financial Advisors, specializes in financial strategizing tailored for dentists. They'll guide you through managing debt, saving smarter, building wealth, and planning your future. Don't let money stress you out. Their expert team is here to give you peace of mind so you can spend more time doing what you love. Visit twinleafadvisor.com, TWINLEFADV.com, or text 321-521-3133 for a free consultation. With Twin Leaf Financial Advisors, your financial freedom starts now. Again, it allows you to save. Like for us, we have to save a lot of money this coming year because we want to have a kid next year, and dentists don't get paid maternity leave. So we need to be able to save a lot of money and keep our savings so we have a big safety net. And if we wiped all that out, we would have maybe had to put off having kids because we wouldn't have enough comfort of a safety net in our bank account. It also allows you just more flexibility. Like I said, if you want to get your student loans paid off because they are higher interest rates, maybe they're private loans or a mix of things. If they're higher rates than your mortgage would be, maybe you want to put your money towards your loans instead of your mortgage. And the other big thing for us dentists is it allows you, like I said, to have cash on hand, but that is crucial to get approved for a practice loan. From my understanding, most banks lending for dental practice startups or acquisitions, a practice loan, want to see 10% of the loan amount liquid in your savings. So whether it's your savings account, checking account, brokerage account, not things like retirement or physical assets like your house or car, but liquid. So if you're doing $1 million loan, they want to know you have at least $100,000 of cash sitting there. You don't have to then drop it all on a mortgage and have nothing left and take years and years and years to save that up again, because then you are limiting how soon you can get into ownership if that's something you want, which in theory should dramatically increase your earnings year to year if you're an owner, after that certain amount of time once you start being profitable. And what I will remind you again, and I mentioned I would talk about it, so I think this is crucial to talk about, is the fact that you don't want to just go to a bank and say, I'm a dentist and I make, let's say you make $280,000 a year, let's just say, and say, how much can I get approved for? Like, you do not want to, you can ask, but do not take out a loan most of the time for your highest amount that they're going to approve you for. Because typically they're going to approve you for 28, 30, sometimes 35% of your gross income. And I think that's absurd. It's too high in my opinion. If you have goals like early retirement or practice ownership or just having money to invest or to do things that you care about, that's just going to take up way too much of your money once you look at what's actually left in your account after taxes. So for us, again, the rules you hear online are like 28 to 30% of your gross income is okay to spend on housing. Our mortgage, just the mortgage part, is going to be about 12% of our gross income, but we have really high property taxes, and those you have to pay into an escrow account the way our loan works month to month. So it all in all comes out to be about 15%. And then plus you also have required homeowners insurance, which of course you should have that, but it's required for our mortgage as well. And so that puts another percent or so on there. It's like $1,000, a couple $1,000s a year. So it's much lower than the recommendation, but I will share with you that we feel, again, we're not living it yet, but we've looked at what our budget's going to look like when we're in the house. We feel our net income with the percent of how much this loan is, which only being 15% of our gross income, we still feel like a little tight with doing a loan at that percent. We really only ever look at net income, so I didn't even know this percent till I was recording this episode, but the mortgage with the property taxes and everything is about 27% of our monthly net income at this point. My husband is in like a traditional salary job, and he has a lot of stuff taken out of his paycheck for our retirement accounts, our health insurance benefits, our HSA, things like that. So that's not directly coming into money that then we can spend. There's less there. And then my income's variable. Hopefully it's going to keep going up. But at this point, what we're kind of averaging from last year to be safe, this is going to be about 27% of our income. And for most people, if you took out a 30% of your gross, this would be like 50% of your net income. And that's just absurd. So please don't do that unless that's how you want to live your life. But in my opinion, please don't do that. So my overall recommendation then, sharing that for us, because we ended up agreeing to a nicer house than maybe we should have at this point, I would recommend not going over 20 to 25% of your net income so that you can keep reaching your savings goals and just not feel strapped or like house poor is the term people use. I am not like too stressed about it, and I'm happy with our choices we made because we plan to live in this house for a long time. We are building a house. It's a custom home that takes a lot of time, effort, and extra money. And we want to be there for 10 to 15 years, maybe more, who knows? So for us, it made sense to kind of push the envelope a little bit. And I didn't want to compromise on things that would be hard to change later or things that are providing more long-term, long-lasting things like structural soundness, really sturdy siding, things, brands with good reputations and good warranties that again would be annoying or expensive to change later. I didn't really want to compromise on those. But we definitely cut back in certain areas, like finding different flooring that was the look I want, but a lot more affordable because floors really aren't that hard to change out, for example. And then there's a lot of things that we would like in this house that we're not doing yet because it would just frankly be way too expensive for us to fork over all the money right now. Like we're not doing our full deck the way we want. We're not finishing our basement at all yet. We aren't doing any cosmetic landscaping, just doing kind of the bare minimum. And we also eventually want to do like more functional, fun landscaping back patio. Like none of that stuff we're doing now. So this is really just like to build the house to have a usable and, in our case, nice looking interior. And it's normal for a home to take time to be fully done, especially at our young ages. It's really tempting to see, I mean, maybe even your perspective, seeing me building a house that I'm really happy with how it looks. It can be pressure to feel like you need to keeping up with the Joneses, that kind of saying, and doing what everyone else is doing and spending a lot because you're a dentist, but you do not need to, and you're going to be much happier and in a better financial position if you continue to live a little bit more low key. You can still have a cozy, charming house that doesn't need to be gigantic. It doesn't need to be bougie. So that would be my advice, is just keep that in mind and know from us that even with our home being only 12% of our gross income, once it all comes through everything we pay with taxes month to month, benefits, yada, yada, what money comes into our bank account, we still feel like the mortgage with the property taxes and all, like, is a lot. It's a big hit. And it's probably just because we're going from renting to owning. But keep that in mind when you're deciding, like, how much do I want to spend on a house, whether you are building or buying. I just recommend keeping it a little lower than we did. So are there any hidden fees? And you mentioned no PMI. What else do we need to know about what you pay throughout this process? That's a lovely question. So yes, again, no PMI is typically a pretty good selling point. There are not too many hidden costs. Closing costs are going to really vary, again, between every single lender. For us, we found that the lender gave us a lot of credits towards closing, so we didn't have to pay very much at closing. And the way ours worked, we actually got money back when we left closing, because essentially we paid a deposit to our builder to hold the lot for us. And that would have been like for up to a whole year while we kind of figured out when we wanted to build, what bank we wanted to use, all of those things. But we wanted to make sure we got this lot. Other ways that people go about it, and more commonly, is that they would buy the lot either in cash and use that as equity towards their loan, or they would even take out a loan on the lot from a bank. So they would have a separate loan, and then once they're ready to build, that would roll into their construction. And again, whatever they paid on the lot over that period of time, they'd be paying principal. That would also be some equity on the lot that they could use towards the loan. But for us, we didn't want to take out an additional lot loan or, again, use a bunch of cash to buy the lot outright, because we knew we would be building pretty soon and we just didn't want extra payments. So we just gave our builder a percent of the lot's value as kind of an earnest deposit, but the bank knew that. So then we went into closing, and our closing costs were much less than that earnest deposit. So pretty much they took our earnest deposit minus the amount of closing costs we had, and then we got a check back for the remainder. So we actually left closing with money, which kind of felt nice at the time. I would recommend saving just in case your specific lender doesn't give you enough closing credits. You might still have to pay out of pocket. You most likely will have to pay something. So typically you want to save 2 to 5% of your loan amount for closing costs, just to keep yourself not stressed. Have that money there, and then if you don't need it, put it towards furniture or a renovation project or movers, or just put it towards your student loans or something else. But having the money there is going to give you a lot of peace of mind. If you can tell through this whole discussion, I'm all about peace of mind and having money for when you need it. So I guess we've reached the point of the podcast where it's good for me to share what all of the crazy out-of-pocket expenses I was talking about. I said that we ended up spending about 10% of the cost of our home extra out of pocket when this is all said and done. And it could be more. We're really hoping it's not, because now we're trying to really lock in for the last 10 to 15% of our project that's being finished and not spend any extra. And like I said, we decided, I guess we can't finish the deck the way we want because we don't want to spend any extra right now. Maybe in 6 months, maybe in a year. But for now, we're trying to really be conscious of the budget because we're pretty much at what we are comfortable spending. Some of these things we paid at the beginning of the project. For example, we had an attorney that we paid for, a construction attorney, which was very hard to find. I just found someone eventually, a friend growing up whose dad is in construction, and then got a contact for someone who's familiar with all this. But any like dental attorneys I knew or just regular attorneys, no one had any contacts to help me. So that was actually very hard to find. But we found an attorney to review our contract between us and the builder and help us with a few negotiations or key terms that help us be more fairly represented, because the contract was a little one-sided in their interest. So we were happy that we did that and it was worth the money, but that was obviously a lump sum because attorneys are expensive. And then we also, as building a custom home, had to pay for the designs of the home. So we worked with a designer, we found a plan online and then took it to the designer and said, we like these elements, but we also want this, or we want this changed this way. We want this area bigger. We want this area smaller. We want to move this here. But we like the exterior elevation. We like the general layout of the house, and then we tweaked it to make it completely custom from there. So we had to pay that person for their hourly rate. And then throughout the past year of technically now, I guess, owning the lot and the project in a way, I mean, basically the bank owns everything since we didn't put anything down, but I guess technically it's ours. We're the ones liable. So throughout this past year, because of that, we've had to pay our HOA dues for the neighborhood still. And then we've also had to pay our property taxes twice, because property taxes come once in the summer and once in the winter. And you pay typically to like your county as well as your state. So we've paid all of that throughout the year. And we also decided to get our lot and our build inspected. So we paid for an inspector to come out once so far before drywall, and then we're going to pay again to have them come out at the end of the project. The house is getting assessed as each phase goes and making sure it's passing code, because that's just what needs to happen when a project is being built. But in my opinion, what is to code might not be as ideal as you would like. Like that's kind of the bare bones basics. But I wanted someone to come out that would check, like, if this was your house, is all of this safe? Is all of this to the highest quality you would expect for the amount that we're paying? And then there were different things that they caught that we needed changed. They did a whole inspection. They did drone footage. They were up on the roof. They were up under the basement. They were up everywhere doing everything. And then same thing now they're going to do at the end of the project, now that everything's drywalled, finished completely. I'm sure there's going to be a bunch of little things that we wouldn't know, because again, we've never owned a house before. We've never built a house. We have no clue what we're looking for, to be honest. So that's why we've been paying for an inspector, and I think that is worth every penny. So here are some areas that we elected to go over budget. Pretty much the way a budget works is that before you even go to your actual bank to really apply for the loan, you can kind of get approved for a rough amount. That way you can start shopping around for lots and shopping around with builders and kind of figure out what you want to do. But before you apply for the real loan, you have to submit a bunch of stuff to the bank about the property, and your builder's going to put all this together, but it'll be a write-up about what the home will include, what's type of finishes, like how nice is it, how big is it, what is the area like. The bank is going to run comps in the area and to assess your estimated value. And then the builder's also going to submit a cost expectation sheet, or I like to just call it a budget, line by line, how much they expect to spend in every category, how much their fee is for managing the project, and then the overall cost. That overall cost is what gets submitted to the bank, and that is what the bank is giving you the loan for. They disperse it in what are called draws, so small little amounts. They're not that small, like $100,000, so not small, but maybe 3, 4, 5, 6 draws throughout your whole project. And as you go, the builders start to use that money to pay off with the work that they've already done, because they shouldn't be broke. They should have some working capital to fund the project. That would be a red flag if they couldn't do any work till the bank paid them. But pretty much that's how a budget sheet works. But we have never built a house, so we did not know what would be a reasonable amount to budget for cabinets and counters, for example. That's the biggest area we went over budget by multiple tens of thousands of dollars. But we chose to, because we weren't happy with the options we were given. And even the basic ones at Lowe's that the lady is like, these are okay, they're not even like our best ones, was still over budget. So like we should have known to have our builders up that category, and then it would have been included in the loan, but we didn't know that. And we ended up finding a custom cabinet builder out here who did everything for a really good rate for the great quality, but it was definitely over budget. And then there were a couple other things like the tile that I picked in certain places, the tile design that I picked. I decided to add an extra window to look really nice. And then I wanted some nicer trim in certain places. So that all was things we like elected to do. No one forced us to spend the money. And we knew it from when we said yes. And we've been saving it and have the money set aside. So it's not a surprise. But there were other things that were surprises. So we also have been saving extra just in case money throughout this process because, for example, our tile installer cost way more than they thought that they would. So that's something that, oh, sorry, we didn't budget right, and it's on us to pay it. That's just how it works during a custom build. And then the other thing is they do save sometimes, thank goodness, a couple hundred, maybe $1,000 here and there for different categories. We're under budget and savings that go to offset overages. So things like drywall, insulation, permit fees, sewer, our carpet, we're all under budget, which is yay. And then lastly, there are a lot of categories we're still finishing in this last little 10 to 15% of the project. So as I said, we're really hoping that we don't go over by too much more. And we're personally not going to elect for any more overages. I think we're just going to let them finish it with the money that they have and see how it is. And if we don't like things, then we're going to just have to change them later when we can afford it. But I don't think we're going to elect for any more overages because we're pretty much at our capacity of what we are comfortable spending. But so what's different about this way we're doing it for a custom home versus a construction loan if you're building in a neighborhood that is more production driven? So like a big name that builds all over Michigan is Allen Edwin, for example. And if you're building with one of them, this is super different and it's a lot easier because you don't have to pay as much money as you go. I don't think I said this yet, but this is crucial to say. For a custom home, when you're doing a loan like we did, each draw is kind of your loan amount as you go through that year of building. At first, you're only paying month to month on a really low loan amount, the first draw that they took out. And then in a month or two, they're going to take out another draw for another $50,000, $80,000, $120,000, whatever you guys agree to. And then now you have that plus the first amount and you pay interest on that for those next couple months till they take out another draw. And then by the time you're at the end of your project, like we are, you're paying for almost the entire mortgage amount in interest, plus your expenses for everywhere else, like where we're renting, things like that. So you're paying a lot. So you have to have cash on hand to pay for that. And the money we're paying month to month does not go towards our real mortgage at all. It is solely interest. It's a complete wash, a complete loss. It doesn't give us a penny of principal. And it is just a thank you, bank, for funding our house and building it, paying to build it. So it kind of stinks, but that's a more reason you need to have a lot of money on hand if you want to build a custom house. So the difference, if you're going to build in a neighborhood that's going up where there's a couple floor plans, there's a couple finishes you pick from, you go to a showroom, you say, I want the Chelsea plan and the 2-car garage, and I want siding number 2 and flooring number 3 and yada, yada. That is not what we're doing. That kind of style is usually going to be a lot easier to finance because it's a lot more straightforward. It's more cookie cutter. Those lenders sometimes have their own lenders, which I don't know if they're sketchy. Like we didn't look into this, but a lot of my neighbors that I know in this area that we live, like they have done things like that and said it was fine to go through the builder's bank, but they'll give you extra incentives. So they'll maybe give you a lower rate, or maybe you don't need to pay a monthly fee. A lot of times you just do an earnest deposit. They build the house and then you start your mortgage. A lot of times you don't need to pay month to month for neighborhoods like that. So that's something to keep in mind. If you don't need like a full custom dream home, if you just want to own a home, but you like the idea of picking some finishes and having it be new, neighborhoods like that are going up like 40 new houses near you, that is going to be way less expensive, but still get you that new house and getting to pick out finishes yourself. So that's something to keep in mind. Let's see. Last couple questions here before we wrap up. Pretty much, I think the last thing I'll say is just answering kind of questions of like where to get started if you want to do this. So what I did was, like I said, we shopped around. We didn't even have a real estate agent, but we just like looked at what was for sale in our area the first year that we lived out here. And we weren't like stunned. Like I said, I just wanted nicer things. I don't know how else to say it. It's not a great quality of mine, but I wanted something specific. So we decided that we would look into building. And when we learned how all this worked, we realized it would be possible for us, and we were really excited and went for it. But we shopped around with lenders, like I said, tried to find someone that would do construction to permanent financing with the physician path, which was hard. I could only find a few banks that did that, and I could only find even fewer banks that would do the full amount, the 100% financing with us putting 0% down. But we did find one. And then we picked the one of those last couple that had a good rate. And then in our case, they had physical locations near us. Some of the other lenders are like virtual banks, so you can't actually ever go anywhere, which we just didn't really prefer. We liked having the brick and mortar. So that's how we picked our bank. And as I said, from there, you either can already own your lot, or you can be going through a big development, which again is going to be a lot easier. And really all you have to do is just find a lender. And if they're a good, nice lender, they're going to guide you through it. You can also use real estate agents for this, but we did not. We didn't feel it was necessary. And then obviously you're paying commissions and things are getting exchanged between the mortgage and yada, yada. And we just felt like it would be added extra money that we didn't want going between people. We just wanted to keep it as simple as possible. So we didn't, but that's also something you can do if you feel overwhelmed about the process. They can help guide you. But then I had someone comment on my TikTok saying their real estate agent told them that they can't get this physician loan and that they don't even exist anymore, which is just sad because I'm pretty sure they exist in every state. Maybe not, but maybe that real estate agent was not into it because they weren't going to get as much money or something compared to someone doing a conventional loan. So just like be careful. It's scary. There's a lot of sketchy people out there when it comes to anything with loans. So do your best. I can give you any insight that I may or may not have if you ever have personal questions, but I think it's a very unique opportunity if you really want to own your own home and you don't quite have the assets and equity to go a traditional route that would let you get a conventional loan. It lets you own a house faster and kind of get yourself set up for that settling down life if that is the direction you want to go with where you're at. So very long episode, but I knew it would be. So I hope this was interesting for you all. If you have any specific questions, again, please let me know. If I missed anything, I'm happy to answer it. Just send me a DM. It can be on Instagram or TikTok, Dental Download Podcast. We have our own TikTok now, or it can be my own page, which is Dr. Haley DDS on Instagram and TikTok. I'm happy to answer any questions that you have. And I thank you all so much for listening to this week's episode.